Every property downturn you can remember had at least one escape hatch. Rates got too high, the market wobbled, and the RBA rode in and cut the rates, throwing borrowers a rope. This time, the rope is gone. It's been welded shut by the 4.2% inflation right at the peak of the 18-year cycle, just as it said it would. National auction clearance rates just printed 47% for the week ending June 21st. So that's our first sub 50% reading we've seen since COVID back in 2022. But freaking out about this obviously is not a strategy. So in the next few minutes, we'll walk through exactly what's happening and then give you the 3 moves that could protect you while everyone else is getting freaked out. So stick around for the third move. It's a very simple one. It's the move that almost nobody makes because it is just too simple. So here's a part that you should look at right now. For 2 decades, the deal between you and the central banks was pretty simple. Things got bad, they cut, your mortgage maths got better, and then you're able to hold on for the ride. That's what we were promised. This time, however, the RBA is sitting in a genuine stagflation trap, and the maths physically won't let them honor this promise. The cash rate's at 4.35 and the inflation is at 4.2%. So if they cut into that, they risk pouring fuel onto the fire. But if they don't cut, then we could see inflation peaking at 4.8% this year, as some of the forecasts have suggested. So, hike. We crush the borrowers who are already hanging on by their teeth. That's the trap. And while retail waits for a rescue, the smart money already understands the cavalry isn't coming. There's no one here to save us. So today, let's walk through those 3 things. Move 1, how to audit your own exposure and find out if you're the one holding on to the winner's curse. Move 2, how to position your liquidity before the exits jam shut. And move 3, the most contrarian play that almost no one talks about for the 4-year down phase, which may have already kicked off, and this ties directly into the 18-year cycle. If this is the kind of breakdown you want more of, then hit the like button and subscribe to the channel. If you want the full framework of the cycle, the 3-part mini course, there's a link in the top of the video description. More on that later. So let's get straight into the data. That 47% clearance rate isn't a 1-week blip. Clearance rates have been below 60% for 10 of the last 12 weeks. The same week a year ago printed 66%. That's a fall of nearly 19 percentage points year on year. Sub 60 signals a slowdown, and then sub 50 signals a genuine loss of confidence and power shifting hard towards the buyer. It's not there yet, but we're getting close. And the prices we're seeing are following that pattern. So look at what actually happened in the last 2 times we saw these declines, right? Back in 2017 to 2019, Sydney fell almost 15% from a peak through to the trough, and Melbourne dropped about 11%. 20 straight months of declines. What stopped it? The RBA cut rates twice in mid-2019, and APRA loosened lending. That's the key part as well, because it creates more credit. The escape hatch opened, the markets caught, and then we saw prices increase from that point. Then it happened again. When rate hikes kicked off in May 2022, Sydney fell another 13%, top to bottom. Melbourne lost roughly 8.5%. And what stopped that one? Well, similar playbook. The cuts came back in 25. Sydney roared to a brand new all-time high by November, but Melbourne, it didn't make it back. 3 years after its 2022 high, even at the top of the recovery, Melbourne was still sitting below where it peaked in March of 22. The rescue worked basically everywhere else except for Melbourne. So here's the pattern you need to see. 2 corrections in under a decade, both deep, both ending the same way. The central bank cut and the market caught onto it. That's the rope that we're talking about, the rescue rope here. Twice in 7 years, it got thrown, and now in 2026, the RBA has reversed course, 3 hikes this year. The cash rate's back at 4.35%. with clearance rates now under 50% for the first time since COVID. Government this time, isn't it? The hand that threw the rope twice is the same one pulling it away. Now, here's why the rescue isn't coming this time. The RBA doesn't expect inflation back inside the target, which is at 2 to 3%, by early to mid 2027. On top of that, you've got an energy shock out of the Middle East. We've seen minimum wages rise to 6% for the lowest paid and then up 4 3/4 for the award wage starting in about a week's time. Both push inflation up, and neither one responds to a rate cut. Then the breaking news we just got. Jim Chalmers, thanks to the Greens, has cut the loophole for SMSFs to borrow to invest in residential real estate. They're taking credit out of the system at the critical stage of the cycle. At the June meeting, the RBA held at 4.35%, but kept the door explicitly open to further hikes as well. That would be more credit out of the system. We need credit to boost these things up. It's the fuel to the fire that we want to see going if we want prices to go up. Some of us don't though. With Governor Bullock, she's reiterating that the board's commitment to returning inflation to the 2 to 3% target band. Higher rates, higher for longer. That means more credit out of the system for longer at the worst possible time. It's all in the 18-year cycle that we've been talking about for years. At the peak now, and then we begin to see things turn. So Westpac, the most hawkish out of the big four banks we have here, it's forecasting 2 more hikes to 4.85% by September, and that's into a declining market, let's say. This creates a brutal mathematical trap. A central bank potentially hiking into a property downturn because inflation has its hands tied. That's not a soft landing, so it seems like a threat. So let's talk about what we can actually do, because that's all the sort of fear and doom. What can we actually do about it? I think we have move 1 here. Audit your exposure and find out honestly whether you're exposed to the winner's curse. You probably heard me talk about that before. Here's where the cycle stops being a prediction and becomes a tool you use on your or in your own situation, right? So taking the theory and turning it into practical things that we can do with it. The 18-year cycle runs roughly 14 years up, then about 4 years down. The last major trough was in 2012. So we count 14 years up from that, we land around 2026. The final stretch of the boom has its name. The winner's curse phase. It's the phase where the last buyers pay the highest prices at the worst possible entry point. And late cycle behavior right now is textbook. Sales volumes are now down around 17% year on year. Consumer sentiment is near its lowest levels in 50 years. And Phil Anderson makes a point that matters enormously here. He argues central banks don't lead the cycle, they follow it, which means rate cuts, even if they come, are too weak to stop cycle's momentum once it turns. So here's what we need to do. You've got to sit down, honestly work through where you're at in this cycle. Work out where you bought in relation to the 18-year cycle. Those who bought at the lowest end of the market in Melbourne and Sydney probably don't have too much to worry about at this point. In fact, some data actually shows Melbourne suburbs with units under 400,000 actually increasing over 10% in the last 12 months. That comes from Cotality. However, if you bought in the last couple of years near the top with a thin deposit in expensive Sydney or Melbourne suburbs, or Brisbane, Adelaide and Perth, then you're carrying the most risk in the entire system. You need to know your real position before the market forces the answer for you. Because you've got to remember from this point, market tops take time to play out. The people who survive these periods are the ones who diagnose themselves early while there's still time to act. It's like selling before the major collapse in Bitcoin or the stock market. So this brings us straight to the problem of acting, because knowing your position is useless if you can't move when you need to. Move 2, position your liquidity before the exits jam. Here's a mechanism almost nobody prices in, and this is for basically illiquid markets. When a market turns, everyone assumes they can just sell and step aside, but the door basically just stays open while there are buyers. If there are no buyers, it's a pretty difficult market to sell into, and at the moment they're vanishing. Governments to be blamed slightly at this point. In a single week, we saw 166 auctions withdrawn in Sydney alone, 370 nationally. Buyers' budgets have shrunk by up to 15% from the 3 hikes already this year. So in dollar terms, that's roughly 30 grand off a single borrower's capacity and 73 grand for a couple. So you can now afford that much less. So even if prices fall, affordability is not improving because the buyer's wallet is shrinking faster than the price tags. And the demand, it's almost gone in some areas. Mortgage demand fell 6.6% year on year in May, according to Equifax. First home buyer demand dropped 9%. In January, that same demand number was positive 10.7%. So in 5 months, mortgage demand swung 17 percentage points in the wrong direction. So now do the maths on what that means for anyone needing to sell into the back half of this year. So here's the action, and I want this concrete because vague advice obviously helps no one. get liquid now while you can still transact. That doesn't mean you have to run out and sell your property. It's about getting finances available if need be. Build a cash buffer and stress test your repayments against, say, Westpac's worst case scenario, which was close to 5%, not at today's rates. On a 600 grand loan, the 3 hikes already added $272 a month. A 4th hike pushes your extra annual costs past $3,300 above where you were in 2025. Run that number against your actual budget today, because right now, despite the hold, 11 lenders have cut variable rates for new customers in the last 6 weeks, and 40 are offering under 6%. There's a real spread between what existing borrowers pay and what new customers get. That window to refinance or renegotiate is open now, but it doesn't stay open for long. Once credit begins to dry up, the banks will pull that too. The whole point of this is to move when you can. Don't be a forced seller who can't find a buyer when the exit finally slams shut. Now here's move 3, and this is one almost nobody is making a point about. Stop fighting the down phase and just start playing it. This is the framework. This is not a quick crash and recovery. The cycle predicts roughly 4 years of decline after the peak. CBA, which is the most bearish of the big 4, is forecasting 6 to 7% fall for Sydney and Melbourne this year, with only a partial rebound in 2027. But I'll be the first to say I don't take the bank's forecasts all that seriously. They don't have a fantastic track record. So let's keep following what the charts are showing and what the data is also saying. Even the most optimistic, you've got ANZ, see Sydney dipping into 2026 before any sort of recovery. But what we know is this is a multi-year setup that will take time to unfold. And there's a second blade coming that makes this down phase different from any of the ones previous. The May 2026 federal budget, and we already saw an update of that this week, slashing more credit. Thanks Labor government. For established properties bought after the budget night, rental losses can no longer be offset against your salary. It's gone with the negative gearing. The 50% capital gains discount is being replaced with indexation and a 30% minimum tax rate. This hits a significant share of Australian property investors, those holding established rental bought after budget night, who've been relying on negative gearing to offset losses against their salaries. Now here's why that matters for the down phase specifically. In a normal correction, investors are the ones who step in and catch the falling knife. They buy the dip. This time, those investors are being removed from the board by policy. So your action here is a mindset shift. Stop thinking like the average buyer that's trying to time the bottom and buy the dip. Start thinking like smart money. It's patient capital. During a rollover, smart money sits, it stays liquid, and gets ready to position for the next down years, which are a few years from now. But if you want the full playbook on exactly how this down phase unfolds, where the next real entry points come, that's precisely what the 3-part mini course is built for. Part 1 is the cycle and the 220 years of data. Part 2 is where we sit in it right now. And then part 3 is how to position for what comes next. You know, it's completely free, links in the top of the video description, no reason not to get it. There's still time to learn and how to navigate all this. This grinds out over years, one cohort of borrowers at a time as the down phase plays out. But the sequence is in motion, and the data this month, I think, has confirmed it. So what do you actually do with it? If you're a homeowner sitting on a comfortable position, simply calculate your exposure and prepare for rates to stay high. If you're stretched, top of the cycle, thin buffer, this is the moment to get liquid and stress test against almost 5% before the choice gets made for you. You don't want to be a forced seller at this stage of the cycle. And if you've got capital, the move is patience, not heroics. And there are some pretty decent interest rates, savings, bank accounts, and term deposits in Australia at this point. Don't catch the falling knife at the peak of the cycle, because it could cost you decades. And I mean decades if you're buying at the wrong time. Market has to go down, then it has to come back, then you got to factor in costs and inflation, and then you begin to make a profit. It's not just about the nominal value. The next real entry comes at the bottom. We're not going to try and time it exactly. We're just going to look for the signals that tell us all about it. But we'll talk about that in future videos. The soft landing is most likely dead, but your survival is not. Know your exposure, secure your liquidity, position for the phase ahead instead of fighting it. And I'll see you guys at the next video and on my technical trading channel, Jason Pizzino. There'll be links in the video description. But until then, take care and peace out.